I'm John Parsons, Head of Global Sales for Bailey Capital. I'm talking to Simon Thandi of UK Landlord Tax, our partner from a tax point of view and company formations point of view, to really lay out investors need to consider when they're looking at buying property, any property, not just specifically our supported housing properties, but any property.
Yes, John, I know we've been working together for some time now, but something that's always intrigued me is what made you reach out to a firm like ourselves who specialise in property tax?
A lot of clients ask us about tax, and I've got a good understanding, but I can't advise them. So we point them in your direction so that they can really get an understanding of not just tax around a property purchase they might do through us, but where it fits into their overall structure.
Right.
Because it's all well and good me saying, well, if you do this and this is what it'll do, but how does that then fit in with everything else that they've got to take into account?
Sure. So from my experience with the clients that you refer on to us is they either had no accountant in the first place, or they do have an accountant, but they're not property specialists.
Yep.
So they kind of almost intuitively realise that they perhaps need something a bit more specialist.
Yep. I would say just about everybody that I speak to, I would suggest that they talk to you, because as you say, some have accountants, but they're maybe running their business, or they would talk to their IFA who said, right, you can take some money out of your pension, but they can't advise them on the overall structure.
Right.
So the properties people buy from us, they're buying for the income. So the goal of having a conversation with yourself is how to maximise that income, because it's all well and good getting income, but if you're paying needless tax, then you're not getting the best out of it.
Yeah, I mean, that's a really interesting take there, because quite often the issue of tax gets left to one side, and it's really a conversation I would think that a lot of investors should have a clear understanding of, so that they can understand how their investment with yourself works. And then as someone who's in that sphere, offering them an all-round service whereby you're not only helping them with their portfolio building, but you've got the added benefit of giving them tailored tax advice, I think gives them more confidence in what you're doing for them.
Yeah.
Yeah.
A lot of people we talk to as well, we talk about buying the property through a special purpose vehicle, a limited company. And we used to use another company to do that, but they gave them no tax advice. And it really became apparent that they weren't getting the best deal. So having somebody who is qualified and licensed to give tax advice and look at the overall books of somebody, the accounts for somebody, makes such a difference. And I have clients coming back to me saying, thank you, I really appreciate that call. Even if they don't do business with us, they appreciate what you bring to the table.
Yeah, great. And as I've said to you, John, we offer anyone that you refer on to us a free consultation. There's no strings attached. And we tend to look at the client's specific situation and lay out the options that are particular for them. And I think quite often when we have those conversations, they are a lot more confident than in the investment that you're putting forward to them, and how the due diligence stacks up from their returns on that investment.
It certainly has helped us make sales by going a step further than a lot of people who maybe are selling property generally will do, because we bring the full package to them. So it's not just the property, it's the lawyers, it's the accountants, it's the structure in which to hold that property. It can make such a difference between making an income and making a good income.
Yeah, great. It's really good to get that feedback from you. So, John, what would you say in your experience is the single most costly mistake that landlords make, and the fix that you think that they need to consider?
So we have a lot of people who have buy-to-let properties already, and they own them in their own personal name, and they realise that there are benefits to be had by holding it in a limited company and seeking proper advice around that. So I get a lot of people going, I've already got properties, but now I realise I need to set up a company. What can I do? I'm not the person to advise them on that, hence sending them your way. But that is probably the single biggest mistake, is people have bought properties in their own personal names and then realise that they need to actually structure it properly. But also people will buy properties with a view that I'm setting this up for my children,
Yep.
but again, in their own personal names. There's no planning around that.
Yeah.
So hence referring them to yourself.
Yeah, no, you've touched on one of the most common questions that we get asked when we're speaking to clients is, you know, how should they own the property? And it often depends on where they are in their property journey. And if they've already got some properties, then one of their immediate concerns is the ownership structure they've now got the right one for them, and what are the options they've got available to them to improve that situation. So yeah, I'd agree with you on that.
Yeah.
Yeah.
Simon, from your point of view, what are the issues that you find people have to deal with where they've maybe set themselves up incorrectly?
Yeah, it varies, but typically they will either have bought the properties in their personal name and then realise that their income tax position is quite exposed, or they will have bought them through a limited company, not taken any advice, and then realise that the actual structure of the limited company needs to be looked at, particularly from an inheritance tax point of view. So it all comes back to where they've got to in their portfolio building. When we speak to clients from the outset, that is the optimum time to set out the structure. But once they've already bought properties, we find that often they haven't gone to a property specialist. They may have gone to a general accountant, and nothing against general accountants, but the discussions that we have with clients is really understanding what it is they're looking to do here. And typically when we speak to clients, especially clients that you refer to us, John, is that they're looking to acquire property to give them income. They don't necessarily need the income today to maintain a lifestyle, but if they needed access to it, it's there for them. But they're looking to build up an additional stream of income to give them more income in retirement, and certainly more and more these days, an asset that's producing income that they can provide on to their children. So they're touching on a lot of things there, and getting that structure right from the outset is critical.
Yeah.
Yeah. So that's what we find.
So it's an advice-led service. You'll take their individual
Yeah.
circumstances into account and then structure a proposition around that,
Yeah.
irrespective of what they hold.
Absolutely. I mean, I'm a landlord myself, so you know I understand it from their point of view as well. I know the challenges of buying property, dealing with the tax, looking at the inheritance tax position. Someone who's bought property, built property, went to auctions and did lots of stuff when I was young. I recognise the journey that they're on. And the thing is this, is when people are buying property, as you know, and with a lot of your clients, you have long-term relationships with them. Yeah, and they are looking to hold these assets as kind of legacy assets that they enjoy the income from, but want to pass on to their children. And so getting that structure right from the outset is where they really make the returns that they really need to pass on. So, you know, we treat every client individually. We give a bespoke service tailored to them. And, you know, it's always a pleasure dealing with clients and opening their eyes to the tax planning opportunities that a lot of them aren't aware of.
So we have a lot of clients who are expats living in Europe, the Middle East, Africa, Asia. Are you able to help those clients, and how, based on the fact that their tax residency is not the UK?
Yeah, no, absolutely. We help them. And in fact, I often get invited overseas to give talks to groups of investors in various countries around the world. A lot of overseas countries have a different tax system. I know, John, you've spent a lot of time in Hong Kong.
Yep.
And you were explaining to me earlier the favourable tax regime they had there. I think the important thing to remember is that there are two tax systems that we need to navigate on their behalf. Firstly, because a property is physically located here in the UK, it will always be taxed primarily here in the UK. And then we need to look at what the tax system's like in the country in which they live in. But very often, under the double taxation treaty agreements between the UK and other countries, there's some very favourable tax planning opportunities available for clients. So when you was living in Hong Kong, because you're British, you would still have access to the UK personal tax allowance, which meant you could get some tax-free income here in the UK. But because Hong Kong is a low tax jurisdiction, you often would find that people living in those kind of countries don't pay any tax in that country either. So for a lot of our non-UK resident clients, quite a lot of them actually pay very little tax at all.
And you can advise them on different jurisdictions, or do you bring in outside assistance on that?
We have a good understanding of the double taxation treaty agreements, which is a crucial legislation there. For me to say to you, I know everything about the Spanish tax system, the Italian tax system, or that would be incorrect. I don't. Yeah. But what we can do is say to them, here's the questions that you need to ask the tax advisor in your country of residence.
Yeah.
And that really is helpful for them, because they can very quickly understand what the tax position is like for them in those countries.
Okay, and on those people, is the advice similar around owning a UK SPV or a UK limited company to own the property, or if they're non-resident, is there an advantage to hold it in their own name or a limited company?
It varies, once again, and it all really depends on what the client is looking to do. I mean, if they're looking to just to hold one or two properties and they're entitled to the UK allowance, then they might be better off just owning it in their personal name, because it's a simpler tax administration. They'll get 12,500 free. So if they're a married couple, they get 25,000 free. And if there's no tax on that income in their country of residence, then 25,000 tax free. Very simple administration. But if they're looking to build up a more substantial portfolio, then more than likely the limited company would still be the route for them. And there are a number of ways we can help them utilise their tax allowances via the limited company. So, as I said, it all depends on what their plans are, what their nationalities are, and which countries they're living. So we look at it individually, we look at the tax treaties between those two countries, and then we advise accordingly.
A lot of our clients have their own limited company doing varying things. Can they hold the property through that, or does it make sense to set up a special purpose vehicle specifically for the property?
Yeah, that's a great question. There's a number of reasons why they would be advised to have what they call an SPV, a special purpose vehicle. So the term special purpose vehicle is a mortgage lender term, and mortgage lenders will often specify an SPV, meaning that the company is only set up specifically for the purchase of property, hence a special purpose vehicle. The reason why mortgage lenders prefer that is they do not like mortgage secured property being mixed up with other trading activities. And the reasons are clear. If something went wrong with the trading business and there was a malicious claim for damages, then you're also risking the property assets, and so they want to ring fence that off. So keeping it separate is where there's mortgage lender is a requirement of the mortgage lender. But there are also other taxation and commercial reasons why you'd want to keep it separately. A lot of the time this is private personal wealth that you're developing, so you want to try and keep that ring fenced off from your trading activities. There are different tax allowances and tax reliefs available for a business whose nature of business is a trading company. So if someone has a manufacturing business and they now invest in property, well, that is regarded as investing, and there are different tax treatments to those things. So that's another reason why they want to keep it separate. So yeah, generally speaking, we would say keep it in a special purpose vehicle.
Okay. How difficult is it to set up an SPV?
It's easy enough to set up, but it has now come under a lot more scrutiny and checking. In the past, Companies House had no checks on directors. Nowadays, they do, and you'll need to personally identify yourself using the government gateway systems to identify the shareholders and the directors there. But nonetheless, it is still a straightforward procedure that, and we set up hundreds of companies every year.
And how long does the process take? And how much of a burden is the admin?
So setting up a company, from getting all the original shareholders and directors' details, can normally be done within 2 to 3 days at the most. Yeah. In terms of the admin, there are 3 statutory filings that a company needs to do these days. The first one is something we call a confirmation statement. And what that is, it's an annual statement that needs to be delivered to Companies House electronically, and that is confirming who the directors and shareholders are. It's a very straightforward piece of admin. The second thing is the company accounts need to be delivered in an abbreviated format and registered at Companies House. Because you're a limited company, one of the requirements is that your accounts are open to public display. But for most small companies, it's really only the balance sheet, and it's a very much redacted balance sheet that you hold on display. So no one's going to know what your income or expenditures are. And then the third one is something that all companies have to do, which is submit an annual tax return called a CT 600 to HMRC. So those are the 3 statutory requirements.
And you take care of all of that?
Yeah, we handle everything from start to finish. We'll prepare the accounts, we'll file them with HMRC, we'll file them with Companies House. We'll also file the confirmation statement. Quite often clients are, we do recommend they use us as what we call the registered office, and that is the address, the official address of the company, which is on display at Companies House. And a lot of clients prefer to use our offices as the registered office so they don't have to display their personal address anywhere on the public register. But it also ensures that any correspondence is sent to us, and in whatever format that's received, whether it's email or hard copy post, we will scan it or forward it on directly to the client so they never miss a notification or any official document.
So I have a number of clients who've got a capital sum, they're setting up a company, they're buying some of our property, but they don't actually need the income at this stage. I often say to them, have you considered putting it into your pension? Do you think that's a worthwhile consideration for some people?
Yeah, it's certainly a tax planning option that we discuss with clients. So typically they have purchased the investment by yourselves, they're generating profits. So they've got an opportunity there or a choice. They can either pay corporation tax, but if they want to avoid the taxation, one of the things they can do to lower it is to get the company to pay the profits into their pension scheme. And subject to criteria, that is a fully deductible expense. And so it's a great way for them to buy an income producing asset, which they can reduce the tax rate down in many cases to very negligible amounts, and then invest that money into a pension scheme. And so they're funding their pensions as well as generating income from the property. So it's a very powerful tax planning tool for them.
Would that still mean that they would have their director's loan owing?
Yes, yeah. This is not a repayment of a director's loan. This is a pension contribution that the company is making on behalf of them as a director or as an employee. So their director's loan account, i.e. the money that they've originally put in, is still intact and available for them to draw down tax-free.
So can you explain a director's loan, how it works? Obviously I know, but...
Sure, yeah. I think it's one of the things that people who are not used to limited companies often find incredible in terms of the fact they immediately see the benefits of it. So typically, if you imagine you're investing in property, you might be a cash purchaser. And let's take, for example, you're buying a property worth, just for argument's sake, £200,000, and you've got the cash, or you're looking to get a mortgage and you're asked to make a deposit contribution, typically these days of around about 25%. So you're putting in...
All of our properties are cash purchases.
Oh, right. Okay,
So,
John.
yeah.
That's great. So they're all cash purchases. So £200,000 property, cash purchase. On day one, the company is set up with your client as the director and obviously the shareholder. And as a director, when they place the £200,000 into the company, it is treated as a loan by them to the company and immediately credited to them on what we call their director's loan account. And a director's loan account is simply a running total of money that the director has put into the company and therefore in credit with the company, or has taken out of the company and not declared it as a dividend, and then they're in deficit. But in this case, they've immediately put £200,000 in. What they can then do is this, is as the company starts to generate rental income, if they want to draw down money from the company and they want to do it without paying any tax, they can simply draw it down against the £200,000 that they put in initially, and that is always tax-free.
Yep.
So that's how the director's loan works. If you compare that to buying property in your personal name, you buy a property for £200,000 in cash, the money's tied up in the property. So even though you're making a profit, you're still taxed on that profit. There's no option for you to draw back down the capital unless you remortgage the property.
Yeah.
So that's one of the tax advantages of limited companies.
So in what circumstance wouldn't it make sense to set up a company to buy a property through?
These days, only if the taxpayer is a lower rate taxpayer, meaning their income, even with the property income, is going to be less than £50,270, and they don't foresee themselves purchasing more property that pushes them above that level, and they're not worried about inheritance tax, or they are not concerned with inheritance tax. Nearly, I would say 90% of the clients that we deal with these days who come to us who start off investing are now purchasing through a limited company. Not only because of what I've just mentioned, but obviously I think most landlords are now aware that mortgage interest is fully deductible in a limited company, whereas in your private name there's a credit limit of 20% tax relief on the mortgage interest.
Talk about the inheritance benefits of owning a property in a SPV as opposed to owning it in your own name, if there are any.
Yeah, sure. So it's one of the most popular queries we get these days, increasingly given the demographic of landlords in the UK. And if you can think along these lines, if you own any property in your personal name, on death, that property asset is included in your estate for inheritance tax purposes. And the current rates of inheritance tax are 40%. You do get £325,000 nil rate band and another 175 residence band. So a single person can leave £500,000 of assets on death, and if they're married, on the death of the second spouse, if the original allowance hasn't been used, they can leave up to £1 million. If you're a landlord and you own your main property and you own a couple of properties, you're more than likely in excess of £1 million just on your property assets alone. If you then factor into the equation that now pension pots are being brought into inheritance tax, and you may have other investments in terms of stocks and shares, 1 million isn't that big a sum anymore. So in your personal name, you're very exposed to inheritance tax. The situation in a company is such that you can avoid the bulk of the inheritance tax by structuring the company in a way that freezes the value of your shares. And it's a structure we call a family investment company, whereby you as the founding investor, parent, are putting in the initial investment to purchase the income producing asset. In this case, it's property. And you can retain full control. So you have all the decision making on who gets money out of the company, buying and selling and reinvesting funds. And you can also retain access to dividend income, as well as getting any money that you first put into the company back as a director's loan. But one of the advantages that we can do with limited companies is that we can freeze the value of your shares by restricting the access to what we call the capital growth in the company. So typically, if you buy property today and you hold it for 20, 30 years or more, the value is likely to have increased. So that increase in value is something that we can assign to shares in children's names.
Yeah.
And on death, because your shares aren't entitled to that capital growth, their inheritance tax value is significantly reduced.